Hey, what's up everyone, and welcome to the School of Personal Finance. So this is Ask Rich episode 3, and I'm sitting here on the beach in Wildwood Crest. It is a very cloudy day out, not a good beach day. So I wanted to get to our viewer question, and it's a good one this week. So the question is from Stephanie, and it's, should I use a home equity line of credit to pay down my mortgage faster? And now this is a pretty sophisticated question, and it brings us down the road of a term called velocity banking. And I'm not going to get into all the details of velocity banking in this video, but I will in the future video. But the basic concept is that you use a line of credit to pay chunks towards your mortgage. And then you put all your cash flow and all your resources towards paying down that line of credit as quickly as you can. And then you go back and you rinse and repeat again, trying to pay down your mortgage, as quickly as you can. So do I think it's a good idea to use a home equity line of credit? The answer is yes. I have a home equity line of credit. They typically don't cost anything to set up. It's a second mortgage on your home, so you have to qualify for it. You have to have good enough credit to be able to get it, and you have to have equity in your home. But there's no cost to set it up, and if you don't use the line of credit, then you don't pay anything for it. So it's like a credit card. It's like you have it there available to you if you need it, but if you don't, it just kind of sits there. And they have different terms than a regular mortgage would have. Like the interest that you pay on the home equity line of credit are typically interest only. So you only have to pay the interest every month, and then eventually there's a point where it comes due, or you have to pay the entire thing off, or you have to refinance it. So how can you use a home equity line of credit to pay off your mortgage faster? And here's a few different thoughts that I have. The first one, you mentioned in your email that you have no bad debt and that you're currently building your emergency fund to 4 to 6 months. So let's just say that you have 30 grand in your emergency fund. So a conservative way that you could use a home equity line of credit is to just go get one, have it available to you, and then use your emergency fund, use your cash to pay off chunks of your mortgage. And now your emergency fund would come from your home equity line of credit. So you don't need to borrow any additional money. You're not going to use the home equity line of credit. You're going to use your cash instead, and your home equity line will act as your reserve if you were to need it. So by doing this, you're taking money that you have sitting in the bank that's probably earning like 2%. You're throwing it at your mortgage. You're paying down your mortgage faster, which in turn is going to save you the interest on it. Right? So now, if you have an emergency, the home equity line of credit is what acts as your emergency fund. And then you work hard to build up the cash again, and then you rinse and repeat. Right? And you could do it depending on your risk tolerance and on your comfort level. If you're very comfortable with this idea, you could take all of your emergency fund, dump it in your mortgage, get the home equity line, use that as your emergency fund, and then build your cash up again, and then rinse and repeat. Or if not, you could do it in increments. Maybe take half of your emergency fund, chunk it down at your mortgage, fill it back up in your emergency fund, save as much as you can, as quickly as you can, and then rinse and repeat. That is one way you could do it that would be less risky, because you're not borrowing any additional money. You're not even using the home equity line of credit. If you wanted to get a little bit riskier, if you have a little bit higher tolerance for taking risk, and it's not even that risky, what you could do is you could actually use all of your cash, pay down your mortgage, and then maybe borrow 10 grand from your home equity line of credit. Throw that at the mortgage as well, and then work hard to pay off that 10 grand using your cash flow. So deposit your paychecks into your home equity line of credit, write your bills out of your home equity line of credit, and then pay it down as quickly as you can and rinse and repeat. Borrow 10 grand against it again once you've paid it off, and just do it over again. This is more with the concept of velocity banking. Either one of those ideas I think are a good idea if, and I know that you are, Steph, if you are responsible with credit, you're not going to blow this money on something, that you have a good credit score, that you don't have any bad debt, and that you're very focused on being financially free, and that you're very stable with your finances. I think that this is a good way to go, that you could pay off your mortgage faster. Now, this is a riskier thing. During the 08-09 financial crisis, I was working in the bank at that time, and the banks pulled home equity lines of credit. They cut them off. We were sending letters out to people saying, sorry, you no longer have access to it anymore. So that's a risk. It could happen. But that's my thought on it. I think that it is a good idea to use a home equity line of credit. Now, not everybody will agree with that. Again, it's a riskier version, right? Dave Ramsey would not agree with this. I'm sure that he would say, do not take out a home equity line of credit. Just work your butt off to pay off your mortgage. Just pay extra at your mortgage, focus on that, and get it done with. And that's not a bad idea. But if you're sitting on, 40, 30,000 bucks in the bank that's earning 2% and you really want to pay off your mortgage, this is a good way to do it. It's a good way to use that cash, throw it at the mortgage, but still have an emergency fund if something were to come up. I hope that answers your question. Let me know in the comments what you think. I will do a video on how mortgages work, how the payments work when you make extra payments towards principal, because after doing a couple Google searches and watching a few YouTube videos, I quickly realized that people really don't understand how the interest works on mortgages. Like, they use front loading of interest as a marketing gimmick to try to sell people on this velocity banking concept. There are other, terms that people use, that the mortgage is making all this money on you in the first 10 years, when really it's just simple math. It's just simple interest. The interest is based on how much money you owe to the bank on your mortgage. And that's really it. So principal payments in the beginning, they really do help cut down on the interest because you don't owe them that money anymore, right? You've made a principal payment, you owe them less, but your payments stay the same throughout the life of the mortgage. They don't adjust down your payment when you make a bigger principal payment. Your mortgage payments stay the same throughout the term of the mortgage. So more of your payment will then go towards principal. So yes, it saves you money on interest when you prepay your mortgage in the beginning, but then you don't have access to that money anymore. So I'll make a video on that in the future because it's an interesting topic, but I hope that this video helped. Sorry if the sound wasn't great on this one. My voice is also a little hoarse. I have a little bit of a cold, but thanks for watching. I will see you guys in the next episode. Hit that like button. Make sure to subscribe to the channel if you've not already. Hopefully we have a little bit better weather here, for the beach tomorrow. The beach is pretty empty today. I will see everybody again soon. Have a good one. Thanks. Bye.